Nothing we say is investment advice. Please pause on all 3 pages of this disclaimer and read it. Greetings, Algo artisans. Today I'm going to show you the right way to identify and use support and resistance in trading. Support and resistance are two of the most basic and important aspects of trading. Before we get into that, get your free algo. The link is in the description. Click on the link. You can give us a real name, fake name. We don't care. We'll send you the algo immediately. With that algo, I actually show you how to turn it into code by using Grok AI, how to turn it into an indicator on TradingView, and I show you the tools that traders use to plug TradingView into their broker so they can trade while they're not at the computer, right? That's the dream. Click the link to see how it's done. As we know, prices go up, prices go down. And as they go up and down, sometimes they actually will touch the same area twice, like here and here. And when prices do that, they tend to create what's called a support. And we can mark that like this. Now, the next time price comes to touch that, there's a high probability that price will go in the other direction. And you can take advantage of that understanding to predict that price will go up here and make some money on the way up. This also works in the opposite direction. Price may go up, touch the same top twice, and then as it comes down, it may come back up to that same point. And when it does, there is a good probability that price will go back in that same direction at that same point where it already had touched a couple of times. And when it does, knowing that that probability is high, you can take a short trade and make money on price going down. This is a pretty reliable way to trade. And what I do is I show you how to do this. I show you how to identify these points on a chart, and then I give you some extra tools to juice up your trade, where you can use these tools right at the point in question when price comes back to the area where you may want to take your trade, so that you might have a better idea of whether or not that trade is going to be successful and filter out the bad trades. Now, there are always trades that don't win, but you can filter a lot of those out by using some different techniques. So let's go ahead and take a look at an example. So this is a chart of the USD/JPY. That's the dollar versus the Japanese yen, and it is a 30-minute chart. So each of these candles is worth 30 minutes of price action. What tends to happen with charts is they end up forming what's called a range. If I were to go back in time, I could identify a range just so you can see what it looks like on a chart. And here is a really good example of a range right here. And the reason I can identify it as a range is because price continues to bounce on the same areas more than once. So you have this bottom right here. You don't really know that you're in a range just yet. Then you have this top right here. You don't really know it quite yet. It does bounce and fall, but once it gets down to here, you realize you're probably in a range. And you can look for price to either bounce here again, or you can look for price to reject off of the top right here as well. And there are a few trades in this range. Let's go ahead and start right here in the replay mode, and we're just going to see if we can identify a range. Now, the way I do that is at every major pivot on the screen, I put a yellow line. I'll show you what I mean by that. At this pivot on the bottom, I just put a line right there. This pivot on the top, I put a line right here, but we already see that this is already broken. We'll see what happens in the next few candles, and we have a pivot right here. And we're just going to see if price starts to build a range that looks more or less like this, right? Consistent bounces off the same areas. We don't see it yet, but as we do, we'll be able to see it quite possibly. So let's go ahead and hit play and see what the candles do. Here, we did get a rejection at the top right there. That could end up being a point. Nope, there goes the next candle. So this pretty much doesn't matter anymore. We'll keep this one here. Watch a few candles and see if we can identify a pivot. Okay, that's a pretty clean pivot right here. So we do see an area at the top right here, and we're just going to put this right about there. Just a general area where this turns around and may create some structure, right? And then we also see this so far obeying this line here. So I'm not going to worry so much about this bottom one for now. Maybe I'll keep it there. But what you can see is so far, this has bounced right here where the prior bounce was before. So let's see if it obeys that. Now at this point, if price comes all the way back up to here, I'm going to take a short because it's already knocked on there twice. It tried to break out and then it rejected down. So let's just see what it does. Price continues up. I'm pretty confident in leaving this down here and putting my box right here at this point. Now we have a decently defined bit of structure on the top and the bottom. We have our supports on the bottom here, and we have our resistance on the top right here. Let's see what happens as the candles unfold. Now I'm just going to take a trade as soon as this hits the top, right? I'm not going to wait for anything. I'm just going to take the trade. I'm going to hit play here. We're almost there. This next candle's probably going to do it. I'll have my orders ready so that if it does come on the next candle, I'm in the trade. My stop loss will be above this area. We can talk about some more precise ways to measure a stop loss in the Algo Factory course. We actually have ways of doing that, but I'm just going to keep this pretty relaxed and just leave a stop loss up there to see how it does. And I'll take my profit before it reaches the bottom here, so somewhere right around there. And this is a 2.2 to 1 trade. And what that means is that if I were to put in $100, I would pull out $121 plus the original $100 that I put in there, having profited 120%. So let's see what happens if I just simply enter the trade as it hits that area at the top here. Okay, let's zoom in. I don't know if it actually actually hit the area? I don't think it did. Let's see if another candle does it. There it is. Okay, so I'm now in the trade right here. And now we get to see if I win or lose. Let's see what happens. Let's play out some candles. I'm nicely in a profit. Price is headed down. I'm pretty comfortable in this trade at this point. I may have moved my stop to entry. There's a lot of things I would have done possibly to protect my position at this point. But either way, that trade just won right there. And as that trade won, what else happened? The candle hit the bottom. So I was out of this trade and simultaneously I was in the new trade because I can take this trade as well. And I'll probably take profits somewhere up here and I'll put the stop loss nice and deep right here. Even as deep as this is a 3-to-1 trade. Even though I have my stop loss below an older structure area and not right here, this is a 3-to-1 risk to reward ratio trade, meaning I can put in $100 and I will pull out an extra 300 plus the 100 that I put in. And I'm already nicely in a profit. So let's see what happens next and if I can win this trade. So far so good. It's taken a minute to make a decision here, but let's see if we can get our profit. And we're there. Okay, so I risked so far in this whole game, I risked $100 and I pulled out $120 on that first trade. And on the second trade, I risked $100 and I pulled out $300, right? So if I lost both of those trades, I would be losing $200. So if those trades stopped out, I would be down $200. But in this case, I'm actually up $420. This is a nice successful little range trade. Let's go ahead and see what happens if I take another short. Okay, so it's probably going to be the next candle. I'll have the order ready to go. I take a short right here and I'll just take profit down here, right? Well, I'll probably take profit before this bit. And there are different ways to take profit as well. Again, we teach a lot of that stuff in Algo Factory. What some people will do is they'll divide the range in half, take half the profit halfway through, and then take the rest off later. There's a lot of ways to do this. But let's go ahead and hit play and just see what happens. Okay, I'm in the trade right there. So if you zoom in, you can see the candle hit there and I'm right in the trade. So let's go ahead and see if I can make money on this trade or not. Almost lost the trade, went really high up, and I'm out of the trade. Okay, so I lost this trade. So far I've made $420, but then I lost $100. So in this period here, I was able to get out in 24 hours, winning $420, losing $100 for a grand total of $320. Great day trading if you can trade for 24 hours like that. And realistically, there's a lot of time to rest in between these trades. As a matter of fact, there's a really good chance you could take all these trades, go about your day, come back later and worry about it because we're just setting and forgetting a lot of the time. Of course, if you're like me, you might be managing the trades. A lot of time, that's not worth it. If you just set, forget, let it take profit or not, then you're good to go. Now you've seen how this popped out of the top right here. Now you know that this range is no longer valid. By the time you've lost your trade, the range generally is no longer valid because it has gone so far out of the range that the range is broken. And so you can just watch it go and like, okay, this is pretty much over, right? You know the range is broken. Perhaps it will come back into the range, but until you have a good definition of that, it's a really good practice not to play around. Now this right here, a lot of people would go ahead and enter long right here. They would consider this to be what's called a deviation. They just lost the trade, but it came back into the range. So perhaps we could even find a way to make some more money here if price can touch the bottom of the range if we're playing by those strict rules, which I always like to play by strict rules. All right, we now have a new trade right here. Let's zoom in a bit here. If I were to enter right as the candle touched, you'd be right here and we could take our profit. We'll just say up here. That is almost a 3-to-1. Let's see what happens. Ooh, see, we lost that one. Okay, so what? We had $320. We made a decent attempt and then we lost another 100. We're still up $220 and that's in about a day and a half. Not even that. Still a great way to go. And another way to look at this is with that new high point, you might be able to identify a new range. So we can start going like this, get rid of our old range and see if price reacts at those same levels once again. Not quite. Now price does seem to be respecting this bottom area with one deviation. We don't have much going on the top side. We do have a little bit of range, but there's not a lot of price action here. This is kind of very choppy waters. If we did see a very strong range develop in this area like this, we could play it. It is very playable. There's just not a lot of room to make money because this is such a tight time, right? And by the way, this is at the market close and there's not a lot of volatility. And these are things that we know as we learn to trade. Suffice it to say, a new range could build and we could take advantage. Again, wash, rinse, and repeat. So let's take a moment and talk about how I define my supports and resistances. When I look at a range, I'm looking for price to touch the top and the bottom twice. So to identify the top of the range, otherwise known as the resistance, I need to see price touch the top twice. Once I have seen price touch once and twice, I can rely on this top part of the range being strong structure. The same applies for the bottom. When I see price touch the bottom of the range and it's touched it twice, then I know I can rely on the bottom of that range to be strong structure. 2 touches indicates the price is probably going to want to pivot again. So in this case, price might head up, touch right here, and the probability is strong that if I simply go short, I will have a winning trade because price pivoted twice there, and it's probably going to pivot again to the downside. The same applies for the bottom of the range. If price makes its way to the bottom, because price has already pivoted twice at the bottom, the probability is high that it will pivot yet again to the upside, and I can win a trade by going long. Now let's take a look at some actual examples of how I find supports and resistances by using pivots. As we can see, price pivoted up, down, and so forth. Now we're going to use what I call the flashlight. If light shines this way, if it can see the pivot matters. If price action crosses in front of a pivot, then that pivot doesn't matter. So this pivot back here is covered up by this price, and the flashlight cannot get through price to see that pivot. Therefore, this particular pivot does not matter, and I would not worry about it. The pivots I can see at this time are way down here and right there. Those are the pivots that matter, and I will mark them with a line. Now the key is, I want to find one of these lines where price pivots very close to it yet again. So let's go ahead and watch what happens with the price action and see if we can identify some opportunities. Okay, so candles are heading up, and we have a little bit of a pivot right here on the top, and you can see price came down and then came back up to touch that same area. Now you'll notice it wasn't the exact same level price pierced through, but that's okay. We have some rules as to whether or not I can use this area as my structure. We do have a double pivot, but let's see if price continues up or if it goes down. Okay, so price does head down after that, so we have a valid double pivot. One pivot right here and one pivot right there. How do I know if I can use this? Well, I'll show you. Now on the first pivot, what I do is I draw a box from the bottom of the wick to the top of the wick, and then I extend that box out to the right. Now if the second pivot gets inside the box, that is the first rule that is satisfied for me to be able to use this as a second pivot. But there is a second rule. If this second candle had gone all the way up here, which it did, but then it closed above this box, meaning there would be a wick that starts up here, I cannot use this as a pivot. But because that candle closed below this level, this green candle right here, even though it touched and pierced all the way through, it came back down and closed inside the box. I now can use this as structure. So if price were to come back up here, I can simply trade it. And that's good news. Let's go ahead and see if that happens, or if we can identify another pivot. Okay, price is heading back up, and we now have a new pivot that we can watch to see if we can use that for structure. This would be for a support. So I will go ahead and put a line right there, and it does appear that we're about to get a trade on the top, and that's great. So how would I trade this if price goes back up here? It's really simple. One of the next candles, any of them, just have to touch the red line, and I will be in the trade. As a matter of fact, I will have orders waiting at that level. So no matter when it touches it, I will be in the trade. And if I lose the trade, I lose it. That's fine. I will put my stop loss above this box, and I will take profit down here. Now there are more precise ways to take profit, and I cover that over at Algo Factory. So that's for the paid subscribers. Let's go ahead and hit play. Okay, looks like price is going to head down. Oh, we got a trade. So price actually touched the box right there, which means I am in this current trade. Let's see if this plays out. So far, so good. Price is in profit, and there's a decent chance at this point I would have moved my stop to entry, but we're just going to let this play out. And I probably would have either won this trade or not lost it. I would have had my stop loss come to entry. And at this point, we have another pivot as well that we can watch for structure. We initially had this pivot, but it got covered up by this price action, and the flashlight cannot see through it. Therefore, the pivot that we will watch is down here at the bottom of this green candle. So either price goes all the way down to our lower pivot and we have structure down there, or we have this pivot right here. Now we either won this trade or didn't lose it, so I'm going to take this off and we're in a new short trade. So let's see if we can get a winning trade, and I'll simply put my take profit in this area. This is a 2-to-1 trade. This means if I risked $100, I would pull out about $200 plus the original 100. Let's hit play. Okay, we won that trade, and on top of that, price covered up this pivot, so it's no longer valid. And we have price touching this lower pivot. So because price has now touched it, it's a possible support. So I'm going to draw my box from the top of the wick to the bottom of the wick, and I'm going to extend it out, and we'll see if we can get another bounce in that area, also known as your support, because now that we have two pivots, we have a valid structure to trade. So let's see what happens. And now it has entered us into a trade on the top. So we can go short. We have one trade that was either no loss or a small win, and then we had a winning trade that took us to the bottom there. Let's see if we can get another short trade that takes us into a win. Nope, we lost that trade, but that's okay. We essentially had a no loss trade. We had a $211 win, and then we had a $100 loss. So still up $100, and this structure is still valid. We just had a bit of a deviation. Price made its way back into structure. So it may be that we can still use this structure to trade. These things do happen in trading. Nothing moves perfectly normally, and losses do happen. So let's see if there's even another opportunity. Now there it is again. And at this point, we would have lost this trade because chances are it would have gone through a stop loss. And if it continues down, that means the structure is broken, or we just have to identify a new structure. And this probably was a news event of some kind. Given that it's 6:30 in the morning on a Wednesday, you would have known a news event is coming and you probably would not have traded it. But let's just say that we did trade it, you would still be up $100, and just entering trades as it hits structure, it's a very, very simple thing to do. So that said, this is the methodology by which we do range trading. And as long as price stays in that range, it's valid. The other way to look at it is if price continues to venture out of that range, you now have new pivots you can look at, and you can make that decision whether or not you want to chase this current range or if you want to look at the outer range to be a little bit safer. That's at your discretion and your testing. But in this case, price did never create a new trade for us, and it definitely got out of the range. Therefore, the question of a new range as per these lines is irrelevant. Either way, this is how it's done. Now that you have seen the way to do it, let's go ahead and take a look at an example as to how it would function. Now let's stick to this area and see if we can identify a new range. Let's go ahead and mark our bottom extreme right here. We also have a local peak right here where price pivoted, and let's see if we can see price bounce twice at any of these areas. Okay, we got a new high up here it seems, so let's move our line up here. We have a pivot down here we should pay attention to. You see this pivot that was made on the way up, right? There's another one here we could also watch. So we're just looking at all of the pivots right now to see if we can get another bounce at any of these kind of larger pivots here. So we'll hit play, and we got a new high up here, or let's add here a high, and let's see if we get another bounce at any of these lines. It should make any sense. Okay, what do we have here? We do have a bounce right here at this line, so we can get rid of this guy here for now, and it looks like we have at least a lower bound with two separate points where price is met. So let's see if any of these upper areas get another bounce as well. This one right here has been covered up by this price action. We'll take that out, and we'll see if we can develop a pattern in this area. We certainly have a lower bound. So what I do with this and how I determine what my support looks like is I go from the bottom of the wick to the top of the deepest candle body. So it's going to look like this, right? And let's see if price goes up to this area once again. And here we are at the top here. Now I can see that this pivot is good enough for me because if I looked at this prior structure and I draw my box to cover the wick to the highest candle body, this hits that area. So now we have two areas where price can be tradable if they reach those areas. So let's go ahead and see if price makes its way to either of these boxes, and let's take a trade. We're right there. If price touches this purple box right there, I can take this trade. Let's see if we get an opportunity. Okay, we're getting there, and there it is. So price dipped right into our box. I can go ahead and put my long position right there. I would have had the order ready to go, and we can put my stop loss below the structural area, and I'll take profit up to right about here. And we're already well in a profit, but this is a 4-to-1, so if I put in $100 and I win, I can take out $400 additional dollars plus the original 100 that I put in. So let's see what happens when I push play. Almost there, and we won. So far, having been patient, identified this structure, followed my rules, and not entered in this gambly candle here, then I've risked $100 and I've made $400 right there. Now let's see if we have an opportunity to go short. Let's look for the candle to touch this upper bound right here. We're almost there, getting there. Well, came pretty close. Had I entered that trade, been a little greedy, I might have been able to win, but it didn't touch. If I zoom in, you'll see that it never touched that area, so I really can't have taken that trade based on these rules. However, there we go. There's the entry right there. So had I tried to take this trade, it would have gone against me very hard. It didn't really get to the point where it would bounce off that structure. If I go short right here, then I can put my stop above there and it can break down. Unfortunately, I lost the trade, but guess what? I made $400 and I only lost $100 right here. So I'm up $300. It took me less than a day to make that money and get out of the range. Now we know that the range is broken. The range is no longer valid. So this is an excellent way to do this range trading. Now there are those who are not comfortable entering their trade as it simply touches these zones, right? There are those who want to rely on indicators, things like that. And what one can do is add in some indicators. So for example, if I were to go back in time to our initial trade here, I could use something very simple, very common like the stochastic RSI. Let's go ahead and add it on there. And I can make a rule where if price touches the zone and then this stochastic flips bullish, then I could enter my trade. And it would give me probably a little bit later of an entry, but also it would give me a much more higher probability win. And it might have kept me out of that last trade. So this is more for the risk adverse people. And my rule will be once price touches is the bottom of the range. I want the blue to cross above the orange on the stochastic RSI. Let's see what happens. Okay, we've touched the area and the stochastic RSI has gone into oversold conditions. The blue crosses up. I can enter this trade. So I would enter it here at the end of that candle, and I would perhaps have my stop loss down here. Now it's only a 1.59 to 1 risk to reward ratio, but it's a more solid trade because I have additional data helping me with confluence, right? So then I can simply see what happens, and we've seen this trade before. We know how this goes, and the trade wins. So people do like to add in different indicators, right? So let's go a little bit deeper. So here's that high trade that we were looking at before that didn't work out, right? This is where we would have taken a short and lost a trade, but we'd have to wait for this stochastic RSI to flip over for us in order to take this trade. So let's see what happens when we do that. We hit play, still hasn't flipped. The blue is still above the orange. Candle broke above. It flipped briefly below the orange, but by the time the candle closed, this was still up here. So what this did was it helped us stay away from a trade that would have hurt us pretty badly. So we got to win that initial trade, and then instead of losing this trade, we won the other trade. Now, this is a very small example. We don't know if using the indicator is going to help us make more money, or if simply going with the range trade is going to help us make more money. And it might be different for the USD JPY than it is for Bitcoin, or say the Aussie dollar, or for a stock. It really all depends on how the asset runs. And the only way to know that is to actually test this. So we'd have to go back through time and test at least 200 examples of this opportunity where we're doing the range trade without the indicator like this. And then we'd have to test 200 times while we were doing it with the indicator like this. And you can run those tests at the same time, right? And it might be the case that simply taking the trade at the support or resistance is more profitable. You get in quicker, you get bigger wins. Sure, you lose more, but it makes up for it with the risk to reward. It might be that using the indicator is going to save you from losing too many trades. It might be that the trades are still big enough to give you a good risk to reward when you win, but then when you lose, not losing that saves you more money. And again, the only way to know that is to test it, to take this, go back through time on whatever asset you like and test it. So thank you for watching. I hope this is a helpful video. If you want to learn more, just go get the free algo and we'll put you on a mailing list. We'll send you more information as far as some of our free trading sessions that go on during the week when you can watch me or watch one of our guys trade. I also had planned to do some quarterly events where people just watch me trade for several days in a row. We went ahead and started doing the live trading instead of that. I may still end up doing one of those events, but the live trading seems to be really popular. So we'll let you know when that's coming. Just pay attention to that mailing list. Thank you for watching, and we will see you on the next video.